All right, let's dive right in. I want you to picture the scene. It's January 2026. The entire financial world is holding its breath as gold, the ultimate safe haven, goes on a ride that absolutely nobody saw coming. A complete roller coaster that basically rewrote all the rules. On January 30th, in just a single day, gold plummeted by up to 112%. 12%. Now, for an asset that's supposed to be the unshakable rock of finance, this was like a massive earthquake. But, if gold's drop was an earthquake, then what happened to silver was a cataclysm. Its more volatile cousin absolutely cratered, crashing by an incredible 36%. It was a complete bloodbath for anyone caught on the wrong side of that trade. And that right there is the million-dollar question, the big mystery we're going to unpack in this analysis. How is it possible that the safest asset on the planet, the money of the gods, could just come crashing down with that kind of violence? The answer, well, it's not simple, but it is absolutely fascinating. To really understand the crash, first you have to understand the incredible rally that came before it. See, the collapse didn't happen in a vacuum. It was the explosive finale to a bull market so spectacular it defied all logic. So let's rewind the tape a little bit. So this is where the story takes a fundamental turn. For decades, the question for the US government was simple. What interest are you going to pay me? It was a safe bet. But by 2025, a real fear had crept in, and the question completely changed too. With all this debt, can you even pay me back at all? All of a sudden, the anchor of global finance wasn't interest, it was default risk. And that one mental shift changed everything. So the bottom line is, you had this perfect storm of four different factors. First, a sovereign debt crisis that made people seriously question U.S. solvency. Second, the fear that the Fed would just turn into a money printer to pay off those debts. Third, you had central banks like China and Russia buying gold hand over fist to get rid of their dollars. And finally, geopolitical tensions with Iran added this fear premium. All the smart money was looking for an emergency exit, and that exit was gold. With all these engines firing on all cylinders, the question on everyone's mind wasn't if gold was going to go up, but just how high could it go? Was there even a ceiling anymore? And that brings us to the climax. January 2026 wasn't a month of optimism. It was flat-out panic. But it wasn't a panic to sell. It was a panic to buy hard assets, anything that wasn't a paper promise from a government. It was a true gold rush. The result was a number that just boggles the mind: $5,595 an ounce. A price that didn't just shatter all previous records, it was a price that would have sounded like science fiction just a few months earlier. But if gold's rise was incredible, what silver did was, well, there's a reason they call it gold on steroids. You see, silver isn't just money. It's a critical industrial component for solar panels, for electric cars, for semiconductors. It was a double whammy bet, a bet against the fiat system and a bet on the technology of the future. And the price just exploded, hitting $121 an ounce. It was a move so fast and so violent, it left traders breathless. For a moment there, silver was the hottest asset on the entire planet. Now, just to give you a sense of the scale of this frenzy, at its peak, the total market cap of gold blew past $35 trillion. For a brief moment, the yellow metal was worth more than all the world's tech giants combined. Old money was back, and it was back with a vengeance. But as the old saying goes, what goes up must come down. And in gold's case, the trip down wasn't gradual. It was a cliff dive. The question is, who or what pulled the trigger? It turns out it wasn't just one thing, but two black swan events that showed up at the exact same time. A perfectly synchronized 1-2 punch. One was political, and the other was purely mechanical. A liquidity cascade. Let's break down how it happened. The first blow came from the White House. Donald Trump nominated Kevin Warsh to run the Federal Reserve. Now, why was this such a big deal? Because the market was expecting someone who would keep the easy money party going. But Warsh is known as a hawk, a defender of sound money. His nomination was like shouting fire in a crowded theater. The whole thesis of an infinitely devaluing dollar suddenly looked shaky. And at that exact moment, the second punch landed. The stocks of tech giants like Microsoft and Oracle suddenly plunged. Hedge funds, who were leveraged to the hilt in tech, started getting margin calls. They needed cash, and they needed it right now. So, what do you sell when you desperately need cash? You sell your biggest winners. And in January 2026, the biggest winners by far were gold and silver. And this is maybe the single most important lesson in this entire story. In a liquidity crisis, you don't sell what you want to sell, you sell what you can sell. Gold didn't get dumped because its fundamentals changed. Nope. It was sold because it was the only liquid asset with huge profits that could be used to cover massive losses elsewhere. In a mad dash for cash, everything goes down together. So, after a fall that brutal, the obvious question is the party over? Was that the end of the great gold bull market? Or was it just a violent shakeout to reset the system? Surprisingly, despite the collapse, the big banks didn't lose faith. UBS is calling for $6,200, Deutsche Bank for $6,000. Their logic is simple. The underlying problems, the massive debt, the de-dollarization, the geopolitical tensions, they haven't gone anywhere. A single appointment can't fix a crisis that's been decades in the making. The general consensus on Wall Street is that this wasn't the death of the bull market, but a healthy correction. A necessary purge that flushed out all the levered speculators, the weak hands, and transferred that gold into the portfolios of long-term institutional investors, the strong hands. So, to wrap this up, you can think of gold as a modern-day Icarus. In January, it flew too high, too fast, fueled by euphoria and leverage, and it got its wings burned. But with the foundations of the global financial system looking shakier than ever and debt soaring into the stratosphere, the real question isn't if it will try to fly again, but just how close to the sun it's going to get next time.